Welcome to Money on Tap. Money on Tap, your personal finance headquarters, where we bring out the professionals' experience and some fun in what we call three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. That's what we do on this show. We look at all sides of the issues, and we bring a fully independent planning perspective to the table.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. So good to have you with us today. My name's Seth Crustman, and I'm joined here with Ben Brayshaw and Dan Mickelin. How are you guys doing?
I'm doing well, Seth. Thank you. Thank you for the nice introduction.
Yeah, doing good here as well. Appreciate it.
Wonderful. Yeah. You guys, we got a rocking show today. You know that?
Well, there's some good, there's some bad, right?
Rocking and rolling like this market, that's for sure.
Yeah. Today, you guys, we have bear bones, the anatomy of a bear. We're going to be breaking down what it is about a bear market, the different parts of it, the different psychology of it. It's a really fascinating topic, and it's probably one that everybody, at least anybody that's aware of the markets, is in right now.
Yeah, I think the thing about this show that's so valuable for a lot of people is trying to understand kind of the components of a bear market and how does that play into, investing, knowing when to pull out, when to stay in, when to really evaluate the overall picture, because we're all managing money. Our listeners are managing money. We're managing money. I mean, there's this constant concern of, where is the next opportunity? When do I just fold the cards and leave the table? When do I say, hey, I'm all in? And that, I think, hopefully we can give that anatomy of the bear market really some clarity for a lot of our listeners so that they can, get a better sense. And honestly, I think when you understand the worst case scenario, or you understand where things can really go, or the kind of the pieces to it, gives you a little bit more, I think it reduces fear. Let's put it that way.
Yeah, I mean, I think, for a lot of people, and especially the analysts and the people who write about this all day long and the information that we read, I mean, they always go back to history, right? So you're always trying to find, what are the range of most common, markets? What about what's happened in the past tells us what the future is going to look like? And hopefully we have some of those indicators here. I mean, nothing's ever perfect from that perspective. History doesn't truly repeat itself in an exact sense. But I do think we can learn a lot, and I do think the market has had certain patterns of behavior over time that become to some degree predictable.
Agreed.
Wow. Again, predictable. Glass balls. Everybody's going to be looking forward to and on the edge of their seat today to find out what is the conclusion. Are we going to be offering some guidance or some hope, or are we going to be, jumping on the bandwagon of disaster trains happening everywhere today? Well, folks, you're going to have to sit tight. We're going to be taking some time to go into money in the news right now, and then we'll be getting on with bare bones. But first, it is time for Money in the News.
And first up, we got here out of Market Watch. Want to keep beating the S&P 500 and at much lower risk? Bet on Buffett and perhaps this younger clone, says a fund manager. And this is from Barbara Kohlmeyer. And this is interesting because there's a couple of names that come up here on the show a lot, and Buffett's certainly one of them. And anybody who's done not necessarily any investing, but any research around investing and investors, Warren Buffett is a name that just really pops up. He's certainly on the Mount Rushmore of managers for sure. And
I wouldn't put him on Mount Rushmore though.
No. We'll leave him off. Sometimes there's room for one more, though, I heard in the past. So Berkshire Hathaway is Buffett's fund. And we've done some shows dedicated to kind of his history and his investment style and, some of his personality quirks. And we've joked about his daily trip to McDonald's, how many times. But the guy's track record is really irrefutable, and he's done very well. In this year, similarly, while the Berkshire Hathaway fund is down about 7%, he is beating the market rather handily. And when the fund manager referenced here in the article, he's just directly says if he had a stock to buy and not touch for the next 5 to 10 years, it would easily be Berkshire Hathaway.
If you wanted to take a class or follow anybody out there in the world of investing, he's always the one that I love listening to and trying to understand what is his perspective, what is his approach. There's some things that in the process of studying him that I completely disagree with. I'm like, he was out on technology. Why? Because he just didn't understand it. And now, well, he's conceded, and apparently he's come to an understanding around technology and has added that into his portfolio. However, you can be a fan or not a fan of Warren Buffett. The truth is that he is incredible at what he does. And the parts around him that if you want to pick him apart, that I would say I really enjoy as much as anything is just, his philosophy and his approach of really coming alongside and wanting to add value to a lot of the companies that he's purchasing and portfolioing. How do you say that? Portfolioing as well.
I'm not the biggest Warren Buffett fan. I think, there's a lot of things that people have mishaps on in investing and where they make their pros and cons. And he's chose some real winners. But I think honestly, having the political power that he has really does afford him a better opportunity of being successful in some investments that, I think if I had his power too, I would probably have done well. I think it's interesting that he has, and years ago we did a show on how he never likes to sell anything at a loss, which I think potentially captures him in a space that's problematic, in a case. I don't think that's actually really true because I think he sold some of the airlines during that scenario, but then turned around and then offered them loans at a much higher yield. So, that was interesting. So, I there's some things that, fundamental investment people that they get themselves too stuck in the world around them and don't, I think if you run too hard of a ship, sometimes you can get caught off guard when these numbers and all this history of the market doesn't really play out the way it has because the world's different and changing.
Yeah, I would say that's one of the things about him that I do disagree with. I think what you can take from him and reading about him is the fact that he has parameters and disciplines and rules that he invests by, and he tries to apply those, I guess, to every position he ever takes. But certainly that's one of them that not everybody's in a position to be able to follow. I mean, when you have billions and billions of dollars in this fund, you can ride a dog for a while. But from an investment advising perspective, I'd probably tell people, hey, listen, there's a lot of opportunity cost that you're letting go by there by holding a dog. At some point in whatever the number is or the percentage or however you feel about it, you do need to cut your losses, and even if it's simply to raise a little bit of cash and get back into something you like better, that's more of a philosophy I'd personally follow. But the thing I do respect about him is that discipline and kind of the structure he works within.
So the article states that Berkshire Hathaway has been beating the S&P 500, and that their belief is that it will continue to do so in the future or in this present circumstance. Understandable, the market down 22%, S&P down 22%, and Berkshire Hathaway is only down 7%. That's significant. And people that are wanting to still be in the market own quality companies and own them with somebody that has a track record of doing very, very well at that. Berkshire Hathaway is the gold standard. That's what I would, attribute to the article and what they're stating here. However, that clone piece was really interesting, where there's one of the challenges around the Berkshire Hathaway holdings is just how massive it is. So really moving the needle there or having maybe better gains in the future would require a little smaller portfolio, or could require a smaller portfolio of holdings. And this company, Markel, is a holding company for insurance, reinsurance, and investments that has been one that's been following in Berkshire's path for about 30 years. And instead of the $900 billion of Berkshire Hathaway, they have about $15 billion, allowing them to, be a little bit more nimble. And that might be one of those opportunities that somebody's, taking a look at and thinking, well, maybe the ticker price on Berkshire is a little pricey for me, or I'm not there yet. This might be another option for them to consider.
Yeah, this Markle fund seems to have done well. It's outperforming Berkshire this year. It's still down on the year, but only about 1.25%, which is, we consider in the climate not bad. And some of the holdings that they favor, and this isn't advice to anybody, but I thought it was interesting to kind of get a peek of the composition of this fund. Is BMW, CVS, JP Morgan, and Lockheed Martin, which, again, all those companies for the year are flat or slightly negative, but still beating the market.
Yeah, I think the healthcare space is very interesting, and I think CVS is interesting. BMW is kind of interested to see that on that list, but not opposed to that at all. But I think it's hard not to make a play. Like I look at CVS, and not that this is a kickoff to that, but they're at like almost a 1 year low. They're $300 billion company or something. Whatever that, and they're just. I mean, with all the aging demographics, I'm not opposed to anything healthcare almost, as long as there's a legitimate, sound business story. I think 20 years from now, you're going to be looking at a higher number. But, what's your time horizon? That's really the question.
Yeah, I mean, CVS for sure has got the market share. They got the size and the scope and the history and the distribution network established. I mean, they're front and center and present in every community in the country, probably.
Yeah, agreed.
So, they got to be doing some things right.
Folks, our service announcement to you is that holiday return prices, and this is what you need to know. This is an article, believe it or not, from Fox Business that is helping us to understand a little bit better what's going on in the service industry and what to expect over the holiday season, because you probably are going to be involved in that and maybe having some returns that it's just going to be a different story if you're out there trying to return some of these things that you might be having to pay for a return.
I think if you're the Scrooge listening to this, you can just shut this part of the show off, right? So
that's me. I'm like,
I can tell you this article caught my eye immediately because it's kind of an ongoing issue at my house. But I hate returning anything. If I bought it, I own it. I mean, that's just basically the way it is. And my wife, on the other hand, will buy 7 versions of the same thing, bring them home, try them on, walk them around, and return 6 of them. And she knew it at the time. And I can't comprehend shopping like that. It just drives me insane. So when I saw this article,
thank goodness she's not an avid listener.
Yeah, hopefully she'll never hear this. I don't know.
I can't tell you how many times I walk in. I'm like, are we? I mean, to me, you buy it, you own it. Yeah. Right. It's a different experience for them.
Well, yeah, my wife always gets mad. I walk over to the shelf, try something on. I'm like, all right, good, I'm ready to go. This was on sale. It was my size. It's perfect.
At least you tried it on. I mean that's a different, maybe because in this day and age where everything's bought online, you don't get to, right? But, some things about this article I thought were kind of forewarning and stuff everybody needs to know, kind of a public service announcement here. But some of the statistics inside of it, though, I thought were kind of staggering. And it says for every billion of sales, $166 million, so 16% gets returned. I thought that was shocking.
That's really high in my mind.
Yeah.
I know people return stuff all the time and then they go and buy something else for their gift certificate or whatever. But I just think it's interesting because there's a lot of these companies like H&M, they're testing out all over, I think it was Norway and some other countries to actually charge people to return their items, so I think that's the easiest, I don't know if they're going to do a deduct from how much you get back, which I think is probably the easiest way to do this versus them paying for it. Some companies are actually asking companies to, literally just pay for the return label. And they're trying this to try to figure out if they can reduce this 16% return scenario. They're just saying, hey, if we can create enough of a little bit of a speed bump that's not offensive to people that they don't shop here, but they return less, what's our net profit?
I think it will have that effect. For instance, Abercrombie and Finch said they're gonna do what you just suggested there. If you return an item, you're going to get $7 less back from the purchase price. So that'll be enough of, I think, an annoyance and aggravator that some percentage of people will say, well, I'll just keep it.
I'm still annoyed at LL Bean for returning their lifetime return policy.
Did they cancel that?
They canceled that thing.
Oh, man.
I think they moved it to a year. I think it's down to 90 days. I'm not sure about the 90 days, but I know it was like I'm thinking, I bought things for a lifetime when I went there. Like, I mean, where's the obligation here?
I've returned some slippers to them that were way past due.
Dan, you're the reason I don't have my lifetime warranty
I might
on
have
mine.
broke the policy. Sorry.
But, it's like my wife and I were joking around. It's always the people who went to the yard sales, bought some old LL Bean shoes, brought them back, asked them for a different size. It's those people that have really ruined it for people,
Well, I've scammed them a little less than that. I actually wore these, but
Yeah.
I got more than my money's worth. And
I will say that I went through 4 different winter coats on the same purchase, though. But they all broke. So, I mean, it's like, don't feel guilty about that.
that's the policy.
Yeah.
That's what it states.
Now the other stuff I bought, it's not covered.
Yeah, I think inside of this, you're just going to see a tremendous opportunity open up for some new retailers to take a different position. And I think you're going to start to see people, go one way or the other. I can't tell you how much I do not like making returns. And then if you were to throw any dollar amount at me to make a return, it would just make it that much harder for me to shop with that company.
So that's really interesting. So EMS had a return, like it was a store credit only on everything. Like you bought it, store credit only on every return, like even if you never took the tags off, never tried it on. And my wife's like, I'm not going to buy anything there because if I buy them for our kids, I bring it home, they try it on, and it doesn't fit. Like, I don't know that I'm not going to find something else. I don't want to have money logged at a company. It's just them keeping our money. It's like, and you forget about it or whatever, you lose the gift certificate.
Yeah, some gift card gets stuffed in a drawer.
Yeah,
it's lost.
gone. And so, anyways, there was a new buyer for EMS, and they changed that policy. It's 90 days now, so return, get your money back.
It was interesting too. Not everybody's going this route. Just for fairness' sake, Walmart is an example. They've actually extended their give back policy, return policy, so now you can keep it a couple extra months or something like that, at least through the holiday season. So not everyone's taking the same stance on this, but just a little bit of buyer we beware as we head into the holidays. Might not be so easy to return things as it once was.
Well, you guys are both getting some from Walmart.
With that, you guys, that's going to be it for Money in the News. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We are talking about bear bones, the anatomy of a bear when we come back.
Folks, we have a lot of fun doing this show, Money on Tap, and Ben and I have been financial planners for years and years, and our goal here with you is to bring you into the room, have the conversations that we have. We think these are critical conversations for you, but we understand this is a limited space, and what we'd love to do is to open the doors to you with us at Brayshaw Financial Group, so you could experience what it means to have three-dimensional planning in your life. Let's take a look at all sides of your situation, your scenario, and see how we can put together the best plan possible, taking into account your risk. How much can you have in the market? How much do we need to have set aside and doing different things for your life? That's what we do as planners, how we engage with you, and we welcome you to do that with us. You can reach us at 855-226-8551 or info@yourmoneyontap.com. Now, if you have $250,000 that are investable assets today, our planning is free to you. We want you to have the playbook to have a successful experience in retirement. Give us a call, 855-226-8551 or info@yourmoneyontap.com. Ben and I welcome you to Brayshaw Financial for complete wealth management.
We appreciate you listening to Money on Tap with Ben, Seth, and Dan. You can contact us at 855-226-8551 or email us at info@yourmoneyontap.com. And now, more of this week's program.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We are talking about bare bones, the anatomy of a bear or a bear market. That's where we're at. That's what we're in. And if you are if you're joining us via radio today, we're glad you're here. We are also in a podcast. We'd love to have you join us in our podcast and get caught up on some of our past shows. There's a ton of information that we love bringing to you, and we only have an hour to do it in. So guess what? You're going to have to sit here with us for this show. And if you want more, go grab it on the podcast.
So as I, we're talking about bear markets today. No one likes talking about bear markets, but I'll tell you what, we all love talking about bear markets when we know we're coming out of one.
Right.
That's the thing about bear markets is they give huge opportunity for people to buy low and potentially, watch a rise. Do you really want to get in the market when it's at its highest, value? That's really the thing that no one wants to do. No one wants to put their money in and watch it just decline. Like, you could hire an advisor, enter at the top of the market, and there's virtually almost nothing you can do. You got Warren Buffett losing 7 to 10%. I mean, it's, it doesn't really matter how good of an investor you are if the whole market pulls back.
It's the rare person that's got the kind of the gumption to be the contrarian, right? But they're the ones that often make out. People get into the market when the news says, "Oh, it's been red hot," or things blowing up through the roof.
Why aren't I part of that?
Yeah, and then you get in, and when you read that, when you've heard it 100 times and read it 1,000 times, then you make your investment, right? You jump into it. That's the wrong time, folks, right? And then we hear people in this spiraling down market. It's crashing. How far are we down? How far are we down? Everybody's, some people are thinking, well, I got to get out. I got to get out. That's the time to get in.
I thought it was interesting. Years ago, we did a show, and I've referenced it a few times. I should probably pull up the data, but it was something about how Fidelity's return, as per the mutual fund manager at the time, and I can't remember which one it was like 5 times better than the average person in his portfolio, because they always sold when the market was going down and bought when the market was high instead of just riding it. And it was like the average investor did like 2 and he was doing like 10 or something like that. So it's just kind of interesting that people don't really stay focused. And I think that's really what comes into play, because if you're really starting to run scared, and this is really where you're feeling vulnerable in the market, with whatever amounts of dollars that you have associated with the level of risk you're taking right now, if that's how you feel, you're really in the wrong investment. I mean, that's usually what I say to people. It's not that an investment is good or bad. It's whether it's appropriate or inappropriate, whether it's suitable or unsuitable. It's always about finding something that you can, no one wants to see the market go down, but, this is an opportunity to buy more. This is an opportunity to really leverage your position. Now, whether or not we're going further down or not, continue buying in a downward cycle is the best opportunity, because you never know when the bottom's going to happen. You're never going to create the bottom yourself. You're not going to be the person who says, "Oh, it's the bottom, let's start moving forward." You're just going to be happy that you bought somewhere around the bottom when you do it. And I think that's really the big focus for people who are really in it to manage through this. The other thing is, you might have some assets that are maybe down a little bit, and you have other assets that are down a lot, and you still like the ones that are down a lot, but maybe they've been oversold. Maybe the contrarian has spooked some interest with you as we approach this holiday, Halloween season. So maybe it's time to rebalance or reallocate, even if you're down in one, but the other one seems to either provide a better opportunity or have some better distance to run.
I mean, you can't really necessarily think of this on an individual stock basis, but if you have 2 things going for you, one is a little bit of time horizon, right? So you need to have the ability to be patient, because nobody knows how long or short any of these cycles can be. But if you also have the belief that the market always returns to where it was and eventually exceeds previous highs, which it always has, then you have to look at this as a discounted market to get into.
Well, when you say that, like an individual stock basis, I would even say that for people, you have to segment your money. There's money now, there's money later, and there's money, much later. And if all of your money's invested as if it's all money now, then you're not invested properly. Like, you time horizon each dollar, each segment. If you don't even know what I'm talking about, you should give us a call at 855-226-8551. I didn't have the number wrong to begin with. But this is something that if you don't understand how to segment your money, how to create money for now and allow other dollars to accumulate in different time horizons so that you can literally watch the market dwindle down and then you can take advantage of the opportunity to invest and then to ride it up. If you don't understand that cyclical opportunity and you're not positioned to take advantage of that, that's something where, getting in touch with someone like us would be really, really relevant for you.
One of the things that you've touched on, it's like, first of all, Ben, you say that nobody likes talking about or investing in a bull market, and I was the one over here that's like, no, I think it's wonderful. Like, I really enjoy. I'm having a lot of fun talking about what's going on right now. For the most part, I have to ask myself the question: what is it about? What's happening? What do I actually like about it? And one of the things I like about it is it forces us to take a look at the discipline that we have around our investing, our strategies, our planning, and all of the things that we've been doing along this journey to prepare for this moment. Because this is what it's about. In the preparation and planning around retirement, this is the inevitability. There is a bear market. And what is it going to give us? It's going to test us, it's going to try us, and it's going to create opportunities all the way around it. One of the things inside of the investor mindset that is such a challenge, and this is why working with the planning and this whole process is so critical for you as an investor or a retiree, and again, why you want to call us at Brayshaw Financial Group, 855-226-8551. That's the correct number in case you're taking Ben's
showing off now.
Number earlier. This is why you want to call us, is because of this investor mindset.
This is how we met Seth. Seth called in.
Yeah. Oh boy, that's another show. So the investor mindset, and everybody's in it. If you are in this process, you are an investor and you have a mindset that's going to follow. There's no way around this. You're going to experience it and you're going to fall into this. We all do. And I just wanted to bring out the single stock because Dan says no singles. I'm just going to bring the other side of this into the perspective for us. This is it. Take a look at Zoom. Everybody, Zoom, right? If you were an investor, or if you were to take a look at Zoom in the pandemic, right? It did the same thing that every stock or everything out there did during the pandemic in March of 2020. And it pulled back. And then it had this incredible ride from April 9th up until October 16th of 2020. We're still in the pandemic. Zoom is actually, at this point in time, becoming more relevant, more subscriptions are happening. It is at the pinnacle of its rise, and it's still rising. People are still piling in the door at Zoom, banging down the door at Zoom. But if you were at that point in time to say, well, maybe I should invest in that, that's a good idea. Your experience today is going to be one of a roller coaster ride, I would say, from hell down, because it is nowhere near where it was at that point in time. And that is something to understand around the mindset, is that you're probably in the what's everybody else doing category. Your mind is probably saying, what's everybody else doing? What's good out there? And by the point in time you've actually gone through the process of onboarding yourself into the idea of the investment, you've missed it, or you've missed a significant part of it. And so having the discipline to pay attention to what's important about the investment, why you're getting involved at a place where probably a lot of people are not interested in this investment, but the fundamentals, the things that are underlying this, or the macroeconomics of what's happening in the big picture around these investments, makes a lot of sense. That's one of the reasons why we will come back to one of the first points around the understanding diversification and how does that work for you in the terms of the bear market cycle.
As we go through this, we've got a couple of things, to kind of walk through, the bones of the bear market. The first thing I would talk about, and just kind of the idea that, you have a bear market is defined by a 20% or greater decline in an index. So if the market's down 20% from its high, you're officially in a bear market. Now, the funny, sad scenario of this is that every index is down over 20% from its high. So I would say we're there.
Yes.
We are definitely there. But as you're kind of going through the different paces of this, the different bones, one of the first bones I would say is just the failed, the kind of the failed rallies, the failed recoveries, the failed attempts to kind of get out of that bear market. And I think as we watch these, we have seen, efforts that have lasted almost a week, of seeing the buying and so forth. And as you pull back, and then all of a sudden we just feel this, just kind of this sucking through, and it just rips the market back down. And we've seen some really horrific days. We've seen some negative, 1,000-point days. We've seen, a 15-point swing, 1,500-point swing on the Dow. One day it was down 500, it was up 1,000. It's just kind of looking at those swings. It's just so massive, and still, yet we are still continuing to create new lows.
Yeah, and another indicator around those rallies that would lend you to believe that it was still in the bear market is that they're the really low volume rallies. So that's a little bit of a complicated stat that not everybody necessarily sees, but volume just takes into account of how many shares are actually trading in the market in a given day. So when you have these rallies, but it's not being heavily traded, it's an indication that the real institutions aren't behind it. Something else is driving some temporary buying that's pushing everybody up, but the heavyweights out there aren't buying it.
Yeah, no one's really engaging across the board, and I think that's where you kind of understand that, hey, there's a point in time where everyone kind of gives in. We'll get to that too, but there's a point in time where the buying is just so massive, it's just so much, and that everyone's kind of conceded this is where we are, this is where we're at. So, the low volume rallies is a big deal, but the strong sell-offs, we've talked about that a little bit in the first one, the failed rallies, but the strong sell-offs are happening. But there's usually going to be like a very, very intense sell-off event. I mean, we've seen some of them, but I don't feel like we've seen that last big sell-off. Will we get it? I don't know. But, the strong sell-off, where investors are getting their 930 statements, this month, the last few weeks. Maybe they haven't even opened them. They're still sitting on the table. They don't want to see how bad it is. But it's that strong sell-off event, and it usually is the catalyst of that is the mutual fund space.
Yeah, when these institutions, that are holding all these retirement plans and just massive quantities of dollars invested in all these different stocks, when those fund managers decide to that they've seen enough and they hit the button. It's not like you or I selling a fraction of our IRA. It's millions of shares just dumped, which obviously has a spiraling effect on the market. So, that's something to always look for, and it may be, kind of an indication of the end, or maybe we're near and finding bottom, is when you see those institutions just really run to cash.
As I'm kind of thinking through, all the different bad cycles we've seen. 2008 being probably one of the more horrific events that we've seen, where it's just like everyone was just, we're out of here.
Total collapse. Yeah.
Total collapse. That piece has not happened yet. And I don't know if we're in that. I don't know if that's how bad this bear market is. Like I don't know. We're down 24% from the high. We haven't quite crossed that 30% scenario. And there's some statistics around that, Dan. I think we should go through, about the 20 versus the 30% down.
Yeah, there's some some of that historical kind of fact checking that folks have done, and what's kind of surfaced in that in analyzing previous bear market cycles is this 30% number, and what that has to do with is it really has in history determined how long it will take to fully recover. For some reason, there's something about that 30% that leads to some major trends. And if you take a look at the average bear market, it's taken 19 months to recover. Now that's all of them, right? But
that's the 20% and the 30% plus.
Yeah, that's the whole range of bear markets, right? If you back test them, all the way back, into the 50s and 60s, that's what the recovery period looked like. But, some of those stats and the way the market moved, kind of way back when, I'm not really sure how relevant they are to today's market. But specifically, if you look at the ones going back to 1982, if the market is, fallen off by less than 30%, we've had some remarkably quick recoveries. In 82 itself, it was 3 months to get back to where it was and reach a new high. In 1990, it was 4 months. In 98, 3 months. In 11, and 18, and in 2020, it was 4 and 5 months.
It's hard to believe that as you take a look back at some of the data that we've actually recently passed through. We remember 2020. Maybe not a lot of people remember what happened in the market, but I remember the conversations that we were having, February and March. It was like this Corona thing. This is, what do you think about that? What's going to happen? Right. And then we just, there was so much going on in our lives outside of the market that to pay attention to. It's hard to realize that, yes, that was one of those pullbacks that was incredible in our market. But just before that in 18, right, there was a huge pullback in the market. And, it's hard to believe it's going back almost, 15 years is, 10 years is the 11 pullback that happened. And going through those market cycles, we had tremendous recovery happen as quickly as we've ever experienced and seen it. And that was a very challenging piece for a lot of the people that were in active tactical management in pulling out of the market. And a lot of people were pulling out of the market. And then the run up on the market would happen so quickly that they would miss really a lot of the opportunity that was inside of that. I think that's one of the things that we're going to continue to stay with is what happens inside of this bear market anatomy. You're listening to Money on Tap. We're talking about bare bones, the anatomy of a bear market. You can reach us at 855-226-8551 or info@yourmoneyontap.com. Yeah, this is incredible stuff that we're in right now. And how close are we? Like when we take a look at these timelines, Dan?
Yeah, well, if we did have bottom and that happened in June, that puts us, 5 months out from kind of the bottom of the market. And, if you think of that stat that we just kind of covered where the average bear market takes 19 months to recover, and presuming, I think, that we don't go below that 30% market, right? That seems to be a really key indicator. But with all those things considered, what averages tell us, we're a third of the way into this thing, and that might be a good opportunity to start dollar cost averaging back into the market if you have some cash.
Yeah, so statistically, if 19 months is your average bear market of all bear markets, it's a year and a half long roughly, and we're 5 or 6 months in. And if you start, dollar cost averaging in over this next 6 months, and it turns out to be a 24-month or 36-month, you're going to be in a good spot. So your time horizon might be, if you've got a 2-3 year time horizon, you might be in a real good opportunity investment wise. I think this 30% scenario is really where we cross a whole different threshold.
Yeah.
This is a very important threshold for you as you're listening to our show to understand the difference between anything between 20 and 29.9999% loss and everything over 30. Because once you go over 30, the recovery period and the length of the bear market statistically, really, really get bad. The longest bear market, which was 2000 to 2002, it was a 31-month bear market, but it took 56 months. It took over 4 years. It took almost 5 years, 4.5 years to recover from that. So if your time horizon's not 5 years and you're staring retirement in the face in the next 2 or 3, that's a phone call to somebody like us immediately. I need to make sure that I'm all set and that I've got a real solid plan, because retirement is not a light switch. I don't know how many people walk in our doors, and I feel bad for them because I'm thinking to myself, if you would just come to me, and we don't talk about this necessarily with our clients as they're coming through it. We just do the best we can with what we have. But the sooner you engage your retirement plan, the more powerful, the more financially stable you'll probably be, like 90% of the time, because planning provides the opportunity. Retirement, between the accumulation phase of pre-retirement and the distribution phase of post-retirement, okay, that light switch is not the best way to do it. And anyone who's living in that capacity and not really making this a priority, this is something you really, really need to do. You need to really make the most of every dollar you have, and the only way to do that is to work with a planner to really build a plan that amplifies the amount of money you keep between how much you're paying in taxes, how much the government's going to take from you, how much the investment potential risk and scenario is going to deplete from your assets, how you create stable income, how you mitigate market loss along with your potential for gain, and how you build time horizons through your dollars and some of the segments that you build. If the things I'm talking to you about sound like Greek, you need to be in here. You need to sit down with somebody and really work through those things.
Yeah, for sure. I mean, if it is going to be a prolonged bear market and you're in retirement or approaching it, and you're planning on taking all your retirement income out of market-based investments, you don't want to be spending down those dollars unprotected for the next 3 years. That'll have just a catastrophic effect.
And that's where we say this almost every show. And I think, if you go to our website at BrayshawFinancial.com, okay, or go to info at yourmoneyontap.com, you can go to our resources tab, and you can literally go down to the videos, go to sequence of returns, look at that video. If that thing doesn't change the way you think about investing, just the absolute comparison between two people doing exactly the same thing, only a couple years apart, if that doesn't change your understanding of the complexity of retirement and what you need to do, you're missing the boat. It's literally 2 clicks. Maybe you type in BrayshawFinancialGroup.com. It's 2 clicks. You watch the video. I think it's 2 minutes long, Dan?
Yeah.
It's 2 minutes of your life. If you're not willing to do that and you listen to this podcast, you're missing out on something.
Oh boy. Yeah. So here we are towards the end of maybe this is the thing. It's like right around now is the timeline piece for us. It's like, where are we at in this whole bear market cycle? And that's the thing that's kind of the linchpin that everybody's wondering, are we in that 20 to 30%, or are we just about to head over that 30% threshold and experience a whole different deal? But one of the things that we're trying to take a look at is the market in terms of where our investments at, or where our investors at with the complacency. Is that where they're at? They've been at? Have we kind of been experiencing a bit of a malaise, or the market's done so well and it's kind of off a little bit, but then it very well could turn into that panic mode, right? Where we've gone through a lot of these mutual funds and other investors pulling out, large investments pulling out of the market, and some of these little mini bull markets that have been happening inside of the bear market. Very, very common, very typical. But, are we going to get to that throwing in the towel point? And I think that's what Ben was just saying and talking about so much is that's the place where things really hinge here for us. And we're trying to understand inside of our own markets right now this is where we're at. So we're keeping a real close look. And one of the things I was going to say is been really a wonderful experience for us with our clients is as we're having our client reviews and we're sitting down and we're doing what we do every year or every quarter or every half year with our clients. This has been a lot of fun for myself and I think it's been really nice for our clients because they're able to see the work that they've done and we've done with them to prepare them for this, and to just have a different experience as they're going through the possible scenarios of a market pulling back further or turning around, having some different confidence.
Yeah, I would agree with that, Seth. I mean, I think we are really in that kind of like that third tier, that kind of like strong sell-off. I don't know that the mutual fund redemption has really, really hit yet. I mean, it just really depends. We got another, 6% maybe to go in on the S&P for that redemption period to just, wow, boom. So if that happens, we're going into a different level of a recession. And we're going to talk a little bit about, some opportunistic perspectives of this too. So I think we're going to try to bring the second side to this here in a bit. But the fourth piece that Seth, as you're referring to, that complacency, right? That kind of like, hey, we're here. It is what it is. I own what I own. It is, there's no reason to sell at this point. This company is worth book value, or whatever the scenario is in its market position. I'm not ready to just absolutely, toss it all in because I have the time. And there's that point. And that's what leads to that fifth scenario the capitulation, and everyone just kind of agrees. It's the end of the end of the end, and, everyone's like, yep, I've got everything I can put into that thing. I've sold everything. I've reallocated. And you have a ton of people sitting in cash, and there's all this cash out there. And there's a ton of cash out there now, which I think is really amazing. There's more cash available to invest now than there's ever been. And it probably has to do something with the $10 or $11 trillion we've printed. But, but there is a ton of money out there, more so than we've ever had on the sidelines. So, there could be a bull run that, may not be able to be stopped when people, say it's time to get in.
Yeah, sometimes you get to that phase where, it's just all bad news. Everything you see is bad news, doom and gloom, and, this is the end. Going to take that next step and just fall off the cliff, and everyone's just tied the blindfold on, and they're accepting of that, And that's kind of an indicator that, things may be ready to turn around. And there's a couple other indicators out there that, again, referencing history, tell us that, there is some reason for optimism, although it's, far and few between. And one of the more interesting things that came across in getting ready for today is that, October is by far and away, it's not even close, where historically looking at bear markets, bottom has been found. And that's across all three indexes too, which right now we're in a bear market in all three. So maybe that's an indicator to us that, hey, we hit bottom and we're getting ready to bounce off.
Folks who are listening to Money on Tap, you can reach us at 855-226-8551 or info@yourmoneyontap.com. We're talking about bare bones, the anatomy of a bear market. We're going to take a quick break. We'll be right back.
If you're listening today and, your questions are outside the box of estate planning or financial planning or any number of the pieces that we kind of traditionally talk about, don't forget that Brayshaw Financial offers auto, home, and business insurance. And we have an entire department that handles all of that for you. Give us a call at 855-226-8551 and be happy to take care of those needs for you. Or email us at info@yourmoneyontap.com.
You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. And now, more Money on Tap with Ben, Seth, and Dan.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We're talking about bare bones, the anatomy of a bear market. And, I think we've made it through pretty much most of the anatomy, and where we wanted to land the ship today was really where are we at? Where do we go from here?
Yeah, that's, hopefully that indicator we just discussed before the break there about October being historically the most frequent bottom point. That's one kind of forward-looking, piece of the information there, and one historical fact in our favor. And the other one that's coming up here, very shortly, is the midterm elections, right? So there's been 19 midterm election cycles since World War II, and in every single one of them, 100%, a year from that point, the market's been higher. So that's you don't get a lot of these 100% statistics. So that's an interesting thing.
Yeah, I think that's really there's a couple real positives here. And I think as we were chatting during the break, when you really look at the market, right, it's down 25%, the S&P roughly. Even if it drops below 30%, that's only a 5% loss. Maybe it goes to 35. Maybe it goes to 40, like 38. Okay. Well, the amount of time you'd have to wait between the down 25 if you invested to kind of the recovery can't be more than a couple of years statistically with all these, numbers that we're looking at. I'm just looking at them from a general perspective. So if you say, hey, listen, I have cash to invest, this might be a really good opportunity just to kind of like, hey, I'm parking this for 2 or 3 years. I know it's down 25. Statistically, I should be up from where I'm going in even now because I'm just not going to worry about trying to figure out. I don't want to be stuck when it has a short rally, 5%, and we're only down 20 from its high. And I don't want to, I just don't want to try to time this thing. You've got that going for you. You've got 100% statistic for the last 19 midterm elections. has a rally. I mean, that's pretty phenomenal. And you know what? Honestly, we're pre-2020 COVID lows, or the high. Right before COVID hit, before the pandemic, before the shutdown, the market's lower than it was there. And I got to tell you, if you remember what it was pre-COVID, the world was on a tear. I mean, we were looking at this as an opportunistic time to buy, a good entry level. Things were looking strong, and we got the Fed raising rates to just offset how much demand there is because inflation is skyrocketing. So from my perspective, yeah, rates are going up. They're trying to shove this thing into a recession on some level. Are they going to do a soft landing? Absolutely not. The only thing transient about the Fed is their opinion, as we've joked around about in the past. I would tell you that I think they are, I think they're a bunch of morons. I don't care how many degrees they have. We have as many countries, lowering rates as we do now raising rates. We're in the middle of wars. We got all sorts of stuff going. The world is going to continue to move. The world has its problems. But we have lots of opportunities in front of us. So I would tell a lot of investors that I really think that just the demographic of the U.S., that global companies are one scenario, domestic companies are another. But I would tell, just looking at another 80 million Americans retiring, looking to spend all this retirement money, there's a lot of opportunities, and then all these people retiring are going to need health care. There's lots of opportunities in a lot of different spaces that I don't think you're going to take the bath that the overall market's going to do, which might require a little bit more strategic planning. It might require more strategic buying. It might literally be, looking at individual stocks. It might really be part of that. It might be looking at annuities. We've talked about annuities. It might be looking at bonds. It might be looking at, there's fixed annuities for 5 years paying 5%. That might be your solution for the next 5 years. There's a zillion opportunities out there to really find real value. The Fed raising rates is not all bad. It's not.
Yeah, they've basically turned inflation into a big sponge to soak up all that fake money that got printed and pushed.
Yeah.
So now that's essentially dried up. The market was to where it was. The economy generally looks good. So there's a lot of good things to find faith in here.
Yeah, and I think, honestly, these midterm elections will clean up, hopefully, a bunch of people who shouldn't even be in office. I'm very hopeful. Maybe we can, wring the neck of a few other politicians to get things the way they should be. I still think that once federal drilling, U.S., think about all the oil that we need, and we've locked it down, and is only creating problems, not helping solve them. That is one huge thing. Everything requires oil. Why in the middle of recessionary events and inflation are we putting a stranglehold around oil in the U.S.? These are all things that once they're relieved, your oil investments are going to go down, but your other investments are going to go up. And that's a big, big deal.
Guys, we've got some great stuff in this show. I've had a lot of fun. I think one of the main ones I wanted to circle back on was diversification and buying the market when everybody else is running is staying disciplined in that strategy. If that is your strategy, having a strategy, having a plan, and understanding where to go from here. There's so many different opportunities, and that's one of the things is the mindset part of this is understanding this is a normal thing that happens inside of our economy, inside of our market. It's necessary to be able to create the next bull run, which everybody as soon as possible is going to get on board and get excited about, and nobody's going to need a plan at that point, right? Except for the people that have done or have been wise with the process and understood the inevitability of this bear market. Folks, it has been a lot of fun today. We look forward to spending time with you and working through the planning process to create your best outcome possible for your retirement. And it is a process, and it is fun, and it's something that we do here at Brayshaw Financial, and we love doing it. Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. That's it for Bare Bones, the anatomy of a bear market. Make it a great week.
The views expressed are not necessarily the opinion of this radio station and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. No strategy, product, material, or tool mentioned can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information, products, materials, or tools mentioned should be relied upon when coordinated with individual professional advice. Past performance is not a guarantee of future results. This show may be subsidized in whole or in part by a product sponsor or issuer. Securities and advisory services offered through SagePoint Financial Incorporated, member FINRA SIPC, and a registered investment advisor. All other services offered through Brayshaw Financial Group LLC are independent of SagePoint Financial. SagePoint Financial and Brayshaw Financial Group do not provide tax or legal advice. Main office is located at 116 South River Road, Bedford, New Hampshire, 03110, and can be reached at toll-free 855-226-8551.
Well, bye.